There's a section of the US tax code that lets qualifying Americans living abroad exclude up to $130,000 of income from US federal tax every year, legally and fully compliant. For married couples where both spouses qualify, that number doubles to over $260,000 combined. And the vast majority of Americans abroad either don't even know it exists or don't claim it correctly. Today, I'm going to walk you through exactly what the Foreign Earned Income Exclusion is, who qualifies, how it works, and how to claim it the right way. I'm Vincenzo. I left a Wall Street career 15 years ago to live abroad, and I've been running an international tax firm ever since, helping Americans in over 150 countries claim this exact tax break. It's the single biggest financial lever available to Americans living outside the US, and today I'm going to make sure you actually understand how it works. We'll cover what the FEIE actually is, the 2 ways to qualify, what counts and what doesn't, and the honest trade-offs most videos on this topic skip. Here's the plain English version. The US is one of only 2 countries in the world that taxes its citizens on worldwide income, no matter where they live. So if you're an American citizen living in Lisbon, Mexico City, Dubai, anywhere outside the US, the IRS still expects a tax return every year. The FEIE is the primary tool Congress built into the tax code to offset that reality. It lets qualifying Americans exclude a set amount of foreign earned income from US federal tax each year. For 2025, that number is $130,000 per qualifying person. For 2026, it goes up to $132,900. The IRS adjusts it every year for inflation. If you earn less than that limit and you qualify, your entire earned income can effectively be shielded from US federal income tax. But it's not from FBAR reporting, and it's not from filing requirements, but from the actual federal taxes owed. Now, the FEIE isn't automatic. To claim it, you have to qualify, and there are exactly 2 ways to do that. The IRS gives you 2 paths. Path 1 is the physical presence test. It's mechanical. It's count-based. You qualify if you're physically outside the US for at least 330 full days in any 12-month period. That period does not have to be during the calendar year. You could pick any 12-month window that gives you your best day count. So if you moved abroad in June, you can count from June to June of the next year, not just the calendar year. The physical presence test is the easier one to prove because it's just math, but it's also the easier one to accidentally fail. A layover in the US disqualifies that day. A day you fly back to the United States disqualifies that day. Time in international waters doesn't count. Every miscounted day matters. Path 2 is the bona fide residence test. It's about intent and ties. You qualify if you've established yourself as a genuine resident of a foreign country for an entire tax year. That means long-term lease, local bank accounts, having local doctors and health insurance, integration in the local community and what the IRS says is social, cultural, and religious ties, potentially tax residency. Even having a gym membership and a library card goes a long way. The bona fide residence test gives you more flexibility to visit the United States without disqualifying yourself. But it also requires proving your life has actually moved abroad, not just your schedule. So a lot of people ask me, so how much time can I actually spend in the US if I'm a bona fide resident abroad? Now the answer is there is no bright timeline, but generally 60 to 90 days, but it could be more if there's a valid reason, such as a personal family issue or even a work project, although the income that you earn while working in the US would be actually taxable in the US. So if you're a digital nomad bouncing between countries, the physical presence test is usually your path. But if you've genuinely moved somewhere and set up a residency, the bona fide residence test often makes more sense. And one thing to note is that you only have to qualify for one or the other, not both. and I see most domestic CPAs get this wrong. Now, once you qualify, the next question is what income the FEIE actually covers. And this is where a lot of people get tripped up. The FEIE only covers money that you earned, money that you actively worked for. What qualifies? Wages from a foreign employer or even a U.S. employer, like W-2 income, for the work that you performed while living abroad. It could be self-employment income, it could be professional fees, it could be any of that. Now, what doesn't qualify? Income that you earned not working. Things like interest, dividends, capital gains, rental income, pension distributions, IRA and 401k withdrawals, Social Security, and really most U.S. government payments. This distinction hits retirees the hardest. A lot of people move abroad thinking their pension or their Social Security will be shielded by the FEIE. It won't. For passive income like that, the foreign tax credit is usually the better tool, especially if you're paying tax to your country of residence on that state of income. One other important detail, even if the FEIE covers your income, it doesn't cover self-employment tax. That's the 15.3% tax for Social Security and Medicare, particularly for people that are self-employed. Now, that still applies unless your country of residence has a totalization agreement with the U.S. that handles it differently. Now, the FEIE is the biggest tax break available for Americans abroad, but it's not always the best one for every situation, which brings us to the trade-offs most videos on this topic don't cover. There are 3 things you should know before you claim the FEIE. First, it's not always the best choice. If you live in a high tax country like Germany, France, or Australia, the foreign tax credit often provides better relief than the FEIE. Because if you're already paying local tax, the foreign tax credit lets you claim a dollar for dollar credit against your US tax, while the FEIE just excludes the income. Second, revoking it locks you out for 5 years. So if you claim the FEIE and later revoke it, you can't claim it for 5 years without formal IRS approval, which means the decision to switch away from the FEIE is a 5-year decision, not a 1-year decision. Third, it doesn't eliminate your filing requirement. Even if the FEIE reduces your US tax to 0, you still have to file a US tax return every year. You still have to file an FBAR if your foreign bank account crosses the $10,000 threshold. You still have to file a Form 8938 if your foreign financial assets are large enough. The FEIE reduces taxes owed, but it doesn't reduce filing complexity. So that's the FEIE. Up to $130,000 of your income legally excluded from US federal tax if you qualify under one of the 2 tests and your income is the right type. If you want to go deeper, the next video on the screen walks you through the 3 most common ways Americans accidentally disqualify themselves from the FEIE and how to avoid each one. That's the tactical follow-up to this explainer. Watch that one next. And if you want us to look at your specific situation and figure out whether the FEIE is the right tool for you, click the link below and we'll get you on a call with our team. Thank you.